All right, good evening, everyone. Welcome to the Hurley Investments Trade Findings and Adjustments for Tuesday evening, the 16th of June. Last week on Tuesday, I made the suggestion of taking advantage of Boeing, and I am still in the process of finding an opportunity to get into Boeing. So if I was looking at moving into Boeing, I'm still looking at 2 to 3 contracts at the 275 January 22 long calls for $36. I bet those are going to be cheaper. I bet if we were to take a look, those are going to be cheaper today than they were when we last suggested them. So let's take a peek. Let's see about Boeing going way out in time. Which ones did we want? We wanted January 22s for $36. Let's hold on. All right. Boeing January 22s. $275s. 32 to 36, and probably getting it at 34. Of course, notice how these buggers jumped $2.30. Tomorrow, if it can get above 200, even though we've been waiting for a week, that would be the time to get into those Boeing leaps. That would be one that might be very interesting. We should have some significant profit. Well, I guess we have some profit. Maybe significant's not the word, but for a lot of the January 351s, worried about time, we took $1 to a couple dollars on some of the contracts. Now it's time to try it again, see if we can't get the bounce on Boeing we expected way back when it was trading at 350. If I was looking at a new trade, I loved retail sales. Retail sales came in today, was supposed to be a positive 9, came in at 17.7. Retail X auto came in at 12.4, which should tell you durable goods is going to be pretty good. Industrial production missed, but it was positive at 1.4. Capacity utilization came in there at 64.8 instead of the estimated 67.9. Business inventories, not a lot of inventories, those were down. So as I'm thinking and looking at everything, retail did amazing. If I went and I took a look at the SPX, got to spell it right. If I don't spell it right, it won't come through. Little bit of a bounce. Couldn't get above the pivot point at 31.53, but that basically leaves 29 points to the upside, almost 1%. In the past, we got to 32.33, and we have support at 30.15 for the 200-day simple moving average. I like the bounce on the RSI. I wish the MACD would get over and the Williams percent are also turned positive. I really don't know what tomorrow's going to bring. I really don't have an idea. I did expect our markets to be up for the week, just following a trend and a pretty standard bounce off of the 200. It looks like pre-market futures are basically flat. The Dow right now is up 63. The S&P is up 6.75. The NASDAQ's up 22.25. All up 0.22, 0.21. Relatively flat for tomorrow. So when I'm looking at relatively flat, I want to find something that can have a pop. I find it rather interesting that we have a stock that is popped based on some good news. That stock is Smith & Wesson Brands Incorporated, SWBI. This stock has moved from 14 up to 18, but basically the short answer is when people are rioting, there's a lot of upside potential. On June 20th, target raised to 21. The FBI did like 1.7 million more guns than expected over the same quarter of the previous year. They went away from American Outdoor Brands Corp. They said, you know what? Why the hell are we listening to our marketing firm when we have a brand name that has been around for 100 years, right? Why the hell would we change our name from American Outdoor Brands Corp when Smith & Wesson has been around, is a brand name that people trust in firearms? You know, it's one of those you scratch your head and you're like, what dummy PR firm talked you guys into that? I kind of giggled, right? It's like, oops, someone screwed up there. Because as much as they tried to tap into the outdoor camping supplies and so forth, they just couldn't get it. Pretty interesting, their industry is recreational products. They did get up as high as 8%, but what an opportunity is all I'm going to say. When I mean what an opportunity, it's run from 560 all the way up to 1847. Some people were in it at that 1847 mark, if not higher. Kind of neat to for those people that had been in it for forever, that said, you know, don't sell me out, I'll take the pain on it. Pretty neat for them. Oh, some have a cost basis. Well, not bad. Some are doing really good on it. So where I'm going at with this is, let's take a look at FinViz. And let's stick in SWBI. It's had a huge run up. 20 was the top that it came down on. It has a huge bottom. if they're nowhere close to where they need to get to. If we go back to the standard chart, way overbought, have been for a month. Taking a look at their fundamentals. Debt to equity at 0.54, long-term debt at 0.53. I love their debt to equity. Earnings the past 5 years has been awful. Earnings this year is up 69.8%. Earnings next year is supposed to be up 83.67. Earnings per share, or PE. PE is rather high. Ridiculously high, especially on an EPS of 26 cents. Next year it could be $1.19. Interesting. Insider owned 1.6%. Institutionally owned 67. I'd like to see that closer to 80. Gross margin, operating, and profit are profitable. Not very much on the profit. Shares float, short interest, 3.77. That's why they spiked higher. And right there, that share float, anytime it gets over 1%, we're looking at some type of short covering rally. I really like this opportunity. Wow, it's what an upside opportunity. A lot of short covering. When I see it like that, very easily we could be up to about 50%, 18 other 9, $27 is the upside when you have a short float over 3%. You could see a 50% move in these guys. Now, on the flip side, looking at the chart, you could see these guys go back down to 10. Let's face it. 10, 988. That is a big downside, a big swing. So, the trade. I would more than likely be looking, if I was going to do this type of trade, I would be let's get a quote. I would want to buy that stock. Better buy that stock, right? Be a 500 for my account. I would be looking to buy a $18.50. Do we have one? $17.50 and 20. This bugger. The monthlies don't have it either. Monthlies have 18. Wow, and if they're expensive, they're $2.50, but 27 would be the high side. So this would be the trade I'd be looking for. If I was looking to get into a position, I would be looking at a protective put strategy. That makes more sense. Protective put strategy. 2085 is not bad, but let's work some numbers with you first. Take a screenshot for that one. The analysis is quite nice. What a run it could have. Infinite profitability. I like where it's at. It just looks like it could be a unique opportunity, especially if we continue the riots, especially if there's a fear that Biden's going to become president and take away all of our guns. This would be the trade I'd be looking at. Working this trade out, though, really quickly. If you were going to get in at 2085, that's your break even. 2085. Looking at a chart, it could get there over time. That's the short answer. It could get there over time. If we were to pull up and spread this out for 3 years, I am pretty sure we're not going to see them up that high. Well, it's not true. In 2017, up at that 24, 25 range. That really is outdated, but that's pretty neat. 24, 25. So I love it. I love that for $20.80. $20.80, we would have $20.85. We could have $4.15 of upside potential. If I was doing my math, looking at a return on reward for 15 divided by 2085, could be a 19.9% return in in nothing more than a month to 3 month period of time. So I like it. I really like that one. That would be one that interests me, that I think could be a really unique trade to be in. If I was going to do a little different one, if you're looking at just an options one, I think this one has the opportunity to be a strangle straddle. So, how would I do this? I would probably do a July, September, doing a calendar straddle. I'm kind of thinking longer term it's going to take off, right? I'd probably go out of the money. September 19 calls. I would be closer in term. 18 puts. Oh, I don't like that. $5.35 up to 25, 27. This one I would struggle with. This one, let's take a look at that chart one more time. This one I might struggle with. If we were to separate our chart out, 6 months, $11.83, 1197, 1184. So if I was to take 1184 minus 18 is $6.16. $6.16. That covers as $6.16 to the downside, covers the cost basis of 537. 616 to fill the gap to the downside. 616. It has $6.16 from the $18 strike price put. $16.16 covers a 535, a 540. That would cover a 540. That would cover a 540 bear put. I would also have out to September at 19. And that's funny because from 19 up to 25 is $6, which would cover the 540. Interesting though, you're risking 540-ish to realistically make $1.16 to 60 cents, maybe 260 to the upside. 60 cents, so doing some simple math, 60 cents divided by 540 is 11%. $2.60 divided by 540 is a 48%. So if it goes up to the upside, 27 gives me a 48% return. $25 only gives me an 11% return. If we're going down, I can make $6.16 divided by 540 gives you 114, but $540.16. We do that. 540 minus 616 is 76 cents. 76 cents divided by the 540 cost basis is a 14%. So a strangle straddle, I'll have to put some of the risk rewards in here, but it makes me like the protective put strategy that much more. I really would like the protective put strategy much better than I would the strangle straddle, but the numbers do work out. So again, if I went to I'm going to go protective put, and I'm doing a calendar strangle. Doing a July 18 long put and a September 19 long call. Total cost basis is equal to, well, I got it in there somewhere. I might as well just put it in here, right? Insert the picture. So total cost basis, you're looking at the call being between $295 and $330. Total cost basis is about $5.40. And what I'm looking at is our chart. If we take a quick look at the chart, all I'm doing is looking at where we're coming down here, and it was at $11.84. So at $11.84, I'm coming up with $6.16 to the downside. So to the downside, I see $6.16 to fill the gap. Which means cost basis of 540 minus, I would say it's 616 minus 540 is equal to a possible 76 cents of profit. That's if we lost everything on the long calls. So 76 cents divided by 540, that's right, come out with 14.07% return on risk. And to the upside, it equals to 2017 high of roughly $25, which means from 19 up to 25, right? From the 19 long call to 25 equals $6 minus the 540 equals a 60 cents possible guaranteed profit divided by 540 equals an 11.1% return on risk. I guess it should be a return on investment, right? You're not taking a risk because they are a debit trade. But my favorite, the one I really like, just your protective put. And if we went through the scenarios on this one, right? Come on, get to my screenshots. Can't remember which ones these are. Let's insert them all. Taking a look at protective put, you're buying the stock, so you're buying to open stock at between 1853 and 1864. We'll just call it 1860 after hours. We'll split the difference. Extended hours says it's 1860. and you're buying to open a July $18 2020 long put for $2.20-ish. That's where we'd have their overall cost basis is equal to $18.60 plus $2.20, or as we would have our order 2080 to 20. I'd probably put it in for 2085. So if we get filled at 2085 and you have the right to sell at 18, we have $2.85 of risk in trade until puts expire. Or let's take, or I guess let's not, no or there. If it goes to $25, then you make $4.15 divided by 2085. I think I'm going to like how this turns out. 415 divided by 2085, 19, it equals 19.90% return on investment. If it goes back to 1184, filling the gap, you can sell at 18 minus 1184 equals 18 minus 1184 equals, wow, $6.16. Or if we did it a little differently, on 500 shares with the right to sell at 18 equals 18 times 500 equals $9,000 divided by 1184 equals a possible 760 shares. And I'd probably just add 200. I'd keep 60 to help pay for my next set of long puts. So I'm looking at it if I'm going to, what's going to happen if it goes up or down. So trade of the day, get yourselves into Boeing. Or you can look at Smith & Wesson Brand Corp. And now you guys have just gone through my whole analysis, top to bottom. Are there any questions you guys have in regards to how I would play Smith & Wesson Brands Corp? Any questions, or did you hear me kind of talk myself through it and you're like, got it, we're good to go? If there are no questions, that's the trade of the day, and I am going to call it good. I'll give you guys 30 more seconds to type anything in that you want to. All right. I was going to say, I don't see anyone else bringing anything in. Here in a couple weeks, not next week, but the week after, I'll be running this from South Carolina. It'll be interesting. We might have Jackie and Jim with me both Monday and Tuesday night live. Abraham, thank you very much. All right, guys, have a good evening. I'll get this posted as quickly as I can. Look forward to seeing you Thursday morning. Talk to you then. Bye-bye, everyone.